what if the key to making sense of today's kind of chaotic market actually lies in looking back? Way back, actually, to the foundational principles of investing.
It might sound a bit backwards, right?
Yeah, exactly. But that's the fascinating idea we're exploring in this deep dive. We're going straight to the source, looking at the early writings of Warren Buffett.
Right, from his partnership days, so 1956 up to 69, and then the first few years of Berkshire Hathaway.
That's the plan.
Yeah.
We've sort of distilled the essence from his public letters from back then.
Yeah, the goal is really to give you a timeless way to look at finance, which can feel pretty confusing sometimes.
Definitely. So whether you're just starting out thinking about investing, or maybe you want to refine your approach,
understanding these core ideas, it gives you a powerful advantage, we think.
Exactly. Our goal isn't to get bogged down in today's headlines or, the latest market frenzy.
No.
Instead, we want to equip you with a solid framework for understanding what really drives long-term success in investing.
Think of it as a shortcut, maybe. A shortcut to being genuinely well-informed.
Yeah, I like that. Gaining insights into evaluating businesses, making decisions based on principles that last.
So let's dive in. At its core, Buffett's early philosophy, it really revolved around one thing: finding securities he thought were significantly undervalued.
Okay.
And this wasn't just about picking, cheap stocks. It was spotting a real gap between the market price and the company's intrinsic long-term earning power. He was super clear about this.
He certainly was. He put it very plainly. My efforts are devoted to finding undervalued securities. I do not attempt to forecast the general market.
That quote really says it all, doesn't it? Sets the whole tone.
Yeah, he wasn't trying to be some market guru predicting the ups and downs.
Precisely. And he consistently dismissed the idea of short-term market predictions having much value.
Right. He said, I am not in the business of predicting general stock market or business fluctuations.
Exactly. For him, all that energy trying to time the market, it was just, better spent understanding the actual business value.
Which feels especially relevant today.
Yeah.
With the crazy fast news cycles and all that. You need an anchor.
Totally. Something more substantial.
And his view on performance, it wasn't about quick wins either, was it?
Yeah.
He had a much longer time frame in mind.
Absolutely. The long game was key. He even said, my thinking is much more geared to a 5-year performance.
5 years.
Yeah.
And even 3 years was minimal for him.
Yeah, he felt 3 years is a very minimal test of performance. He understood that the true value, especially with his kind of value picks, it might take years for the market to, catch on.
Short-term ups and downs can hide what's really happening with the company.
For sure. And in this era of instant info and quarterly earnings pressure, having that kind of long-term patience, it's tough.
Yeah, it's a challenge.
But as Buffett's track record shows, incredibly rewarding if you can manage it.
Which also meant, and this is interesting, he was okay with lagging behind sometimes.
Yeah.
Like when the market was just ripping higher.
Yeah, he admitted it. In strongly advancing markets, I expect to have real difficulty keeping up with the general market.
It's almost a paradox, isn't it?
Yeah.
A super successful investor saying he expects to underperform now and then.
But it flows right from his commitment to value, see? When everything's driven by hype and speculation.
The real bargains disappear.
Exactly. His discipline just stopped him from chasing overpriced stuff just to keep up.
Patience again.
Yeah, and he said it flat out. Our business is one requiring patience. And that wasn't just waiting for prices to rise, it was also waiting for the right chances to buy.
Okay, so undervalued is the key concept.
Yeah.
How did he actually define that or find it back then?
Well, his main strategy, his bread and butter, as he called it,
right,
was buying securities trading way below what he thought they were truly worth, their intrinsic value, and then selling when the market kind of woke up to that value.
Simple concept, hard to execute.
Definitely. But he also had a couple of other categories. Workouts, he called them.
Workouts?
Yeah, these were tied to specific company actions like mergers or liquidations. The profit depended more on the event happening than the overall market.
Okay. More predictable, maybe.
Potentially, yeah. And then there were control situations. That's where he'd buy a big enough stake to actually influence the company's direction, try to unlock value the market wasn't seeing.
So not just passively investing then?
Not always, no. Especially not in those control situations.
And underlying all of this was that crucial idea of a margin of safety.
Oh, absolutely essential. Couldn't do without it. He insisted on buying at a price that gave him a big cushion, a buffer against mistakes or just bad luck.
He said something like, the price should be so good that even a mediocre outcome works out okay.
That's the one. Have the purchase price be so attractive that even a mediocre sale gives good results. It's like buying a house way under market value so you've got room if you find unexpected problems.
That makes sense. That difference is the safety margin.
Exactly. And that was his main tool for avoiding permanent capital loss, losing money for good. That was always his biggest worry.
Speaking of risk, his whole style sounds pretty conservative fundamentally. Was that intentional?
Oh, absolutely. No doubt. He explicitly said, I would rather sustain the penalties resulting from over-conservatism than face the consequences of error.
Wow. So avoiding big mistakes was way more important than chasing the absolute highest return.
Far more important. Protecting capital first. That mindset, it's really a cornerstone of why he's been so successful for so long.
And he thought the real test of that conservatism was how things held up when the market went down.
Spot on. He noted, I feel the most objective test as to just how conservative our manner of investing is arises through evaluation of performance in down markets.
Makes perfect sense.
Yeah, because that's when you see who's built on solid ground and who's maybe taking too much risk. You know the saying, right? About the tide going out.
And finding out who's swimming naked.
Yeah, exactly that. And his commitment was crystal clear. We will attempt to bring the risk of permanent capital loss to an absolute minimum.
It's also pretty important, I think, that his own money was right there alongside his partners. He wasn't just playing with other people's money.
That's a huge point. Skin in the game, totally. He made sure people knew. He said, my wife and I will have the largest single investment in the new partnership.
And later on, it was basically everything they had.
Yeah, he revealed his and Susie's stake was virtually our entire net worth. When your own future is that tied up in it, well, it sharpens your focus, doesn't it?
Absolutely. Shows how serious he was about the principles and protecting that capital.
Definitely.
Now, another theme that keeps popping up in those early writings is his belief in, thinking for yourself. He didn't seem to trust committees or groupthink much for investing.
You're totally right. He was pretty skeptical of big investment firms, actually.
Really?
Yeah, he thought outstanding investment management rarely comes out of large groups making decisions together. He had a few reasons. Well, the pressure to just go along with the group, the desire to conform.
The safety of the herd? Sort
of. Also just institutional inertia, the way big places work. And sometimes he felt they led to kind of irrational diversification, just spreading money around without real conviction.
Interesting. So for Buffett, real conviction had to come from your own homework, your own reasoning, not just because it was popular.
Precisely. He famously said, you will not be right simply because many people momentarily agree with you.
Mm-hmm.
For him, you needed the facts, solid reasoning, a well-thought-out case. He believed true conservatism is only possible through knowledge and reason.
That feels incredibly relevant today, too, with just the fire hose of information and opinions everywhere.
Totally. Knowing why you believe something based on facts is key.
And this idea of independent thinking, it also shaped how he handled diversification, which was quite different from the standard advice, right?
Very different. He wasn't spreading bets super thin. Initially, he ran a pretty concentrated portfolio, maybe 30 to 40 stocks, carefully chosen ones.
Okay, 30, 40 is still quite a few, but...
But, and this is the kicker, under specific conditions, he was willing to put a huge chunk, up to 40%, into just one single investment.
40%? Wow. Okay, that sounds... pretty bold. What were those specific conditions? Must have been strict.
Extremely strict. He said it would only happen when there was an extremely high probability that our facts and reasoning are correct. So super high conviction.
Okay.
And also a very low probability that anything could drastically change the underlying value. So not just conviction, but also perceived safety in the core business itself.
So it wasn't just a gamble. It was deep understanding plus a big safety margin.
Exactly. Not reckless at all, in his view. Just intense focus on the absolute best ideas where he felt he really, really knew what he was doing.
And he had that funny analogy about why too much diversification could be bad, didn't he? Something about a harem?
Yeah. He quoted Billy Rose saying over-diversification is like, you've got a harem of 70 girls, you don't get to know any of them very well.
It's memorable.
It is. And it makes the point, right? You need to actually understand the businesses you own. Hard to do if you own tiny bits of hundreds of things.
Which brings us back to that focus on the business itself, not just the stock ticker. Thinking like an owner.
That's another cornerstone, yeah. He talked about it all the time, thinking of investments as owning pieces of actual businesses.
He said something like, When you have control, you own a business, not just a stock.
Right. When a controlling interest is held, we own a business rather than a stock. And he truly believed, I think about them as businesses, not stocks. And if the business does all right over the long term, so will the stock.
It's a fundamental shift in perspective, really.
It absolutely is. And it drives everything else.
So digging into the business fundamentals, it's long-term prospects, it's competitive edge, the management that was just non-negotiable for him.
Totally non-negotiable. He insisted we should understand the business and check that it has favorable long-term prospects.
And he trusted that if he got the business value right, the stock price would eventually catch up.
Yeah, that was the core belief. Maybe not tomorrow, maybe not next month, but eventually. As he put it, over the long term, intrinsic value is virtually always reflected at some point in the market price.
So the market's mood swings, the daily volatility, that wasn't something to fear.
Not at all. For him, it was an opportunity. He wrote, with this approach, stock market fluctuations are of little importance to us, except as they may provide buying opportunities.
See, a great business you understand offered at a silly price because the market's panicking.
Exactly. That's your chance if you have that long-term view and the conviction.
Now, besides the numbers and the business model, he also really cared about the people running the show, right? Management quality.
That's hugely important. Quality and, crucially, honesty. Non-negotiable. He looked for businesses operated by honest and competent people. Simple as that sounds, it's vital.
And he liked managers who thought like owners themselves, long-term view.
Yes, he really valued that proprietary interest, as he called it. Managers who acted like it was their own company. He even mentioned specific people he admired, like Vic, Jack Ringwalt, Gina Begg.
People who'd built their businesses and still cared deeply, even after selling?
Exactly. That owner's mindset. That's what he looked for.
Okay, so shifting gears a bit, how did he actually measure success? Both his own investing success and the performance of these businesses he owned. What metrics did he focus on back then?
Well, for his own performance, he looked long-term against a benchmark. Specifically, his goal was a 10 percentage point per annum advantage over the Dow Jones. Pretty ambitious.
10 points above the Dow consistently. Yeah, that's aiming high.
It is. And for the businesses themselves, he really liked looking at the return on shareholders' equity. Call it a very important yardstick of economic performance.
Okay, ROE. Makes sense.
Yeah, and related to that, the ratio of operating earnings to shareholders' equity. That was his preferred way to gauge how well the business was actually performing in any given year, operationally.
So focused on profitability relative to the capital invested.
Precisely. Assessing how efficiently the business was generating returns.
It's also, I find it quite refreshing, how open he was about making mistakes. Even someone like Buffett.
Oh, absolutely. It's striking, isn't it? Even in those early letters, he'd just say, it may turn out that I am completely wrong. No hedging.
Or that time he said, our poor experience this year is 100% my fault.
Yeah. Just complete ownership. He understood that, errors are just part of the game in investing. Doesn't matter how smart or experienced you are.
And the important thing wasn't avoiding mistakes entirely, because that's impossible, but learning from them.
Exactly. He even said something like, it is encouraging to realize that our record was achieved despite many mistakes.
That's a great way to put it.
It really underscores the idea that success isn't about perfection. It's about having a sound process, a good philosophy, and then just learning as you go, fixing what went wrong.
So as we kind of wrap up this deep dive into Buffett's early thinking, what are the big enduring lessons about long-term investing that really stand out?
Well, ultimately, it all comes back to the power of long-term compounding, making decisions based on, as he put it, the most probable compounding of after-tax net worth with minimum risk.
Compounding with minimum risk. Key phrase.
Absolutely. And he warned against getting sucked into short-term thinking. He said if managers and investors focus too much on quarterly results,
they attract shareholders who only care about the short term too.
Right. Creates the wrong dynamic. And the fact that these ideas from, the 50s and 60s are still so relevant today, it just shows how fundamental they are.
Okay, so for you, the listener, listening to all this, what are the main takeaways from digging into Buffett's early ideas? I'd say, first, really understanding the businesses you invest in, truly understanding them, not just the stock symbol.
Yeah, critical.
Second, developing that long-term perspective. Patience. Resisting the noise.
Definitely need that patience.
And third, the value of thinking for yourself, doing your own homework, not just following the crowd.
And I'd add that focus on avoiding big losses. That margin of safety, the conservative approach, that's huge.
Right. Protect the downside.
And also, don't forget the people. Judging the character and competence of the managers running the companies you own, that's timeless too.
So here's maybe a final thought to chew on. Considering Buffett's early focus on intrinsic value, on the long-term business, on independent thought, how much of your own approach to the market, how much is aligned with those principles versus how much is maybe driven by, the daily news, the predictions, the short-term stuff?
That's a really good question to ask yourself.
Yeah. And in a world just drowning in financial info, what are your filters? What are your criteria for finding the insights that will actually help you in the long run?
Definitely something worth pondering.
Absolutely. Well, thanks for joining us for this deep dive.